Good evening, everyone. Time for another silver update. I'm not going to get any charts tonight because I need to spend all the time that I have chasing down all of the rabbit holes and rabbit trails that are connected to this story. This is a very, very, very big story. Detroit to default today, shared sacrifice to follow. So I'm going to read a little bit from the Zero Hedge article, and then I'm going to try to delve into this and see where this leads. Now, I've been warning about this for years. In fact, my pension Ponzi, the last one I did was back from 2011. If you remember, Meredith Whitney had warned that these things were going to happen. This is the beginning, and I'm going to show you how these sorts of things can be as Nassim Taleb has pointed out, the flapping of a butterfly's wings can be an event that spreads throughout the entire system. So this is potentially one of those events. It's a potential black swan, and I'm going to show you why. So let's read a little bit of the Zero Hedge story to start with. And so the next casualty of the inevitable municipal collapse appears, which is, as expected, that one-time symbol of all that was right and once upon manufacturing America, having since been replaced with the anti-symbol of all that is broken, Detroit. Detroit begins moratorium on all debt service payments for unsecured funded debt. Detroit to default on certificates of participation due today. And true to form in the new normal America, where the fairness doctrine rules supreme under Big Brother's watchful eye, the premise of the upcoming glorious recovery is a well-known one: the shared sacrifice. To wit, the city currently faces approximately $17 billion in total liabilities. Detroit is insolvent and cannot meet its financial obligations without a significant restructuring. Mr. Orr's plan provides for shared sacrifice among all creditor groups. Now keep this in mind, because this is a term that people bandy about but don't actually think about what it means. Who are the creditors and what are creditor groups? And I'm going to attempt to prove to you that pensions are going to take a haircut either way, because we are talking about pensions versus pensions. So let's keep going. From Wall Street and Main Street, consistent with their legal rights in order to return Detroit to a sustainable financial foundation and to permit much needed reinvestment in the city, the punchline: Detroit's road to recovery begins today by defaulting. So I don't have the time to go into the detail of this plan, but a very, very important aspect here that is mentioned: the plan proposes to modify pension benefits consistent with available funding. Now remember, people, I've told you for years that pension obligations are going to be reneged upon. It is a mathematical certainty. And my first question when I started to look into this is, well, who are the creditors who have these obligations, and who's going to take the loss? Someone's going to take the loss. And as we begin to delve into that, it just gets stranger and stranger. So let's look at this PDF that's on the Detroit Free Press. You can see this is a very long 134-page proposal for creditors, June 14th, 2013. And this goes into all of the details about the horrible state of the economic situation in Detroit. You can see the declining population, the employment in Detroit, number of employed Detroit residents, and you can see how low that is. Unemployment in Detroit hovering around 20%, and it goes into the revenue. And there's just so much here. I don't even have time to go into any of it. It's a very detailed report, and it's very, very interesting. You should read every bit of it because this is a look at what's coming across the country. This is just a vision into what's going to happen. But what's very, very interesting is when you get down to the bottom and look at the bonds, and those are going to be in the appendix. And there's a whole bunch of these bonds. Here's the water system bonds, and you can see, yeah, the columns. We're going to get back to these, but before we do that, I want to look at a story that was written about this, and this was from yesterday. Detroit debt owner, and that's the representative who's doing this whole thing, the guy who's appointed, or will come up with a plan to repay bondholders in full. Now that's funny. But anyway, so it goes into the primary holders of the bonds. In other words, these are the people that are going to take a haircut. Nuveen Asset Management, Franklin Resources, Inc. And my first question that I wondered about is, okay, if Detroit is going to have to default on their debt obligations, then who are the creditors? If they're going to try to prevent the people who have pensions from taking a massive haircut, then they're going to force the creditors to take a massive haircut. And we're going to find when we look into this that making the creditors take a massive haircut means making somebody else's pension take a massive haircut. So that's going to show you that the entire thing is a massive Ponzi scheme, and as we delve into it, it just gets much, much worse. So the first one here is Nuveen Asset Management. Nuveen Investments is a Chicago-based private company in the asset management industry. They're owned by Madison Dearborn Partners. They were acquired by that group for $5.4 billion. If we go and look at Madison Dearborn Partners, we find out that what they are involved in is their investment funds are a series of private limited partnerships, and investors include a variety of pension funds, endowments, and institutional investors. So back behind this, the investors in the pensions are pensions. So let's go back to the story. The next one is going to be Franklin Resources, and bear with me here because I've got so much information that it's hard to get to it all. And Franklin Resources, Inc. is a publicly owned asset management holding company. The firm provides services to individuals, institutions, pension plans, trusts, and partnerships. Okay, so there's the second one. There's your first two owners of the debt that are going to take a haircut, and they are firms that sell investments to other pensions. So we've got pensions on one side and pensions on the other side. But we don't need to worry about that because we can see when we go down to the bottom of this article that we have insurance. So we have comfort for Detroit here. Michael Camarella at Oppenheimer Funds Inc. in New York said he will get paid no matter what Orr does, because the company has only general obligations that are backed by the city's unlimited tax pledge and by insurers. He expects those companies, quote, to make payments so bondholders don't miss a beat. He's very optimistic. Chris Alwine, Vanguard's head of muni funds in Valley Forge, PA, said he's comfortable holding Detroit general obligations insured by units of Assured Guarantee Limited. Oppenheimer Funds ranks fourth in Detroit muni holdings, followed by BlackRock Advisors LLC and Vanguard, Bloomberg data show. Should the city of Detroit fail to make required debt service payment for any reason, including a bankruptcy filing, National's insured bondholders are guaranteed their scheduled interest and principal payments on time and in full. Annenberg owns the National Public Finance Guarantee Corp's chief risk officer said in March 5th statement. Assured Guarantee, quote, is committed to honoring its unconditional and irrevocable guarantee to holders of its insured obligations, according to a statement from Ashwita Durrani, a company spokesman. Michael Fitzgerald, a spokesman for AMBAC, declined to comment. Michael Kerbali, a spokesman for Syncora Guarantee, Inc., didn't return an email. So let's go and look at those bonds. And we talked about how there are insurers behind these, so nobody's worried. You can see the appendix list of these bonds. Here's the sewage disposal system bonds. And like I said before, $17 billion. That's not just these bonds, but everything together. Now you can see your insurer here. We've got MBIA, we've got FGIC, we've got Assured Guarantee. These are the ones that we were talking about. Oh, look, there's Berkshire Hathaway. And we've got MBIA, Assured Guarantee. That's that set of bonds, and we have more down here. So most of these are guaranteed. So we don't have to worry about it. They're guaranteed by these companies. So let's go ahead and take a look at some of these companies. Let's start off with AMBAC. AMBAC emerges from bankruptcy. AMBAC Financial Group, this is May 1st, announced today the effectiveness of its second modified fifth amended plan of reorganization, which marks the completion of its financial restructuring and AMBAC's emergence from Chapter 11 bankruptcy protection. So here's their stock, and it's traded precisely 2 days. If you remember AMBAC, that was one that took a huge dive when the crisis began in 2008. It promptly went down to nearly nothing. Now, another one of these is Syncora Holdings. Syncora. It's SYCRF. And you can see that at the beginning of the financial crisis, it was about $34. Took a dive down to basically nothing. And we're talking about 22 cents. So recently they've upticked to $1. And they have a market cap of $52 million. So I'm sure when all of those billions of dollars of bonds are either defaulted on or given a haircut or bankrupt, I'm sure that Syncora is going to step up and pay that money. Here's AGO. This is Assured Guarantee Limited, and they're at least at $22 a share. But they're located in Bermuda, and if we do a insider transaction on them, it seems that there's a very large amount of shares that were dumped about May 30th. So that's AGO. Now, FGIC, which is another one that was listed here, you can see that FGIC, according to this headline from June 12th, Fir Tree Partners, a $10 billion private investment firm and major policyholder of FGIC since 2008, today praised the confirmation of the company's plan of rehabilitation by Judge Doris Ling Cohen of the Supreme Court of the State of New York. The plan, which was confirmed yesterday, is expected to go effective by the end of August. So how is it that we have basically bankrupt companies or nearly bankrupt companies or offshore companies or companies that will be probably bailed out by the taxpayer ultimately are the ones that are insuring these bonds, but they don't really have any assets, so they can probably go belly up when they're called upon to come up with the money to back these. Now you can see the interest rates, and if you follow Charles Hughes Smith of Two Minds, he's done a couple of articles recently on this very thing, the coming bankruptcy of all of these municipalities. You can see how high these interest rates are. You actually have this Series 2001C with amount issued of $148 million. They borrowed $148 million. They're paying 6.5 to 7% interest. So you know what the saying is, if something seems too good to be true, it probably is. Here's a 7.5% interest rate on a maturity date of a bond that matures in 2032, 2033, and it's paying 7.5% a year. So that's a fantastic investment. Of course, the bottom line is, now that Mr. Orr has announced, everybody's going to have to take a haircut. So this is one gigantic Ponzi scheme. The creditors of Detroit are pension funds, and the people who are going to receive the payments are pension funds. And this is the beginning of the austerity. This point here, right here, the plan proposes to modify pension benefits consistent with available funding. There is no available funding. The city's bankrupt. The number of government employees is far too high, and this could be a black swan event, because you can see how all of the firms that back up all the debt, everyone that's going to take a haircut, is already either gone into bankruptcy or pre-positioned to escape from it, or is set in a position to escape the obligation. So you can go through the rest of these rabbit trails. They're infinite, but the bottom line is this, that gold and silver are different than every other asset, because physical gold and silver are not anyone's obligation. They are an asset in and of themselves. And you can see, when we just look very briefly into this default that happened in Detroit today, we can see that there's a potential for cascading default, because everybody who guarantees everybody else doesn't have the ability to pay, and everybody's going to have to take a haircut. And we'll talk to you next time.